2 hours. That's all it took. Between early Tuesday morning and mid-session, $4.2 billion in silver market value was erased. Silver dropped from 91 to 85 in 120 minutes. A 7% haircut. At the exact same time, gold surged nearly $100 higher. Gold up, silver crushed. Same macro backdrop, same war headlines, same safe haven narrative. Completely opposite price action. If that doesn't make you pause, it should. Because what happened Tuesday morning wasn't organic price discovery, it was a mechanical event. And I'm OG John. In this breakdown, we're walking through the structure, the tools, the sequence, and the money trail. No speculation, just documented exchange mechanics and publicly available data. Let's start with what your screen showed you. Silver spot collapsing from 91 to 85. Session low around 85.15. Some platforms briefly printing 85 flat. A 7% drop in 2 hours. Price stabilizing near 87 as I record this. Gold at the same time pushing toward 54.15, up roughly $100 on the session. The gold to silver ratio had compressed to 54 during Monday's war spike. By Tuesday afternoon, it exploded back to 61, a 7-point expansion in a single session. That kind of ratio move does not happen randomly. It requires one metal to be aggressively sold while the other is bid. Here's the mechanism. Overnight, after the Monday close, CME Group raised silver futures margin requirements by 30%. No mid-session announcement, no gradual phase-in. After hours. If you went to sleep Monday long silver futures, you woke up Tuesday to a different rulebook. Here's what that means mechanically. A futures contract requires margin, collateral. If margin was $10,000 per contract, and you held 10 contracts, you needed $100,000 posted. Increase margin 30% overnight. Now you need $130,000. If you don't have the extra $30,000 immediately available, your broker issues a margin call. If you can't wire funds quickly, your position is liquidated automatically at market. Not because you changed your view, not because fundamentals changed, because the exchange changed the collateral requirement. Open interest dropped roughly 800 contracts. Each contract is 5,000 ounces. That's about 9 million ounces liquidated. At $85, $90 silver, roughly $765 to $810 million of forced selling. But the larger number is not the contracts closed. It's the price move applied across total open interest. Roughly 124,500 contracts outstanding. That's 622.5 million ounces of notional exposure. A $6 price drop across that exposure equals $3.7 billion in notional value reduction. Add ETF and OTC spillover, and you reach the $4.2 billion figure. That is the scale of the reset. Now ask the obvious question, who benefits? When forced sellers dump contracts at market, someone is on the bid. Forced liquidation doesn't pick its exit price. It sells into liquidity, and the largest liquidity providers in silver futures are commercial banks holding concentrated short positions. The same banks, shown in the Commodity Futures Trading Commission Bank Participation Report with roughly 40,000 contracts short. The same category of institutions that were deeply underwater as silver ran from the 60s to the mid-90s. The sequence matters. Friday, silver surges on geopolitical escalation. Monday, silver pushes near 97. Monday night, margin increase. Tuesday morning, liquidation cascade. Tuesday afternoon, price reset lower. I'm not naming a specific institution without documentary proof of a petition. What I am stating is structural reality. When margins rise sharply during peak short pressure, leveraged longs are forced out and concentrated shorts stabilize. Historical precedent exists. In 2020, JP Morgan Chase paid nearly $920 million in fines related to precious metals market manipulation covering prior years. That is public record. Now look at what didn't move. Physical premiums. American Silver Eagles and Canadian Maple Leafs held roughly $3.50 to $5 over spot. Paper printed 85, physical transactions, clearing closer to 88.90 equivalent. When premiums hold or widen during a paper decline, it indicates physical buyers are not retreating. ETF flows showed continued creations in major silver funds. That requires physical sourcing. COMEX registered inventory remains around 88 million ounces, still tight relative to delivery interest. March delivery standing unchanged. No mass cancellation of demand. Margin requirements do not add metal to vaults. They do not reduce industrial consumption. They do not cancel military procurement. They do not increase mine output. They simply alter leverage. Now factor in geopolitics. Gold responded directly to safe haven demand. Silver, temporarily, did not, because it was trading through forced liquidation mechanics rather than discretionary positioning. The gold to silver ratio's jump from 54 to 61 in hours is statistically rare in a crisis window. Historically, sharp ratio expansions during conflict events have reverted over subsequent weeks as silver realigns with gold's macro move. Nothing about global mine supply changed Tuesday. Nothing about structural deficits changed. Nothing about industrial demand vanished in 120 minutes. What changed was collateral policy on a derivatives exchange. This is the difference between paper pricing and physical demand. Paper price reflects leverage conditions. Physical price reflects supply and demand. When those two diverge, convergence eventually resolves the gap, but timing is not linear. The key distinction is this. The sellers Tuesday morning were not fundamentally bearish investors. They were margin-constrained participants. The buyers were capitalized entities with liquidity. That is a transfer, not a disappearance. History offers an example. In 2011, repeated margin increases halted silver's vertical run near $50. Paper collapsed. Physical premium surged. The futures chart looked catastrophic. Coin sales spiked. The structural backdrop today is different. Multi-year supply deficits, tighter inventories, stronger industrial draw, and elevated geopolitical risk. Whether margin intervention has lasting impact depends on one variable: sustained physical demand relative to available inventory. Margins influence leverage. They do not create silver. Everything discussed here is publicly verifiable. CME margin notices, CFTC positioning data, daily inventory reports, ETF creation statistics, public enforcement settlements, 2 hours. $4.2 billion in notional value reset, a 30% collateral adjustment. A 7-point ratio expansion? That's not emotion, that's structure. I'm OG John. Verify the data, watch the inventories, watch the ratio, and watch what happens when paper mechanics meet physical constraints.